Hi there, welcome to my channel. In this video, we are going to continue our discussion on the consolidated statement of profit or loss and other comprehensive income. Thank you for tuning into my channel. If this is your first time on my channel, please subscribe to the channel and consider hitting the like button, and also consider sharing the video so others can also benefit. Alright, so let's get back into business. So our business for today, as I said at the end of my previous video, is that we are going to consider how to prepare the consolidated statement of profit or loss. The last video was on general introduction to the consolidation process. We looked at why we need to consolidate the statement of profit or loss. We also looked at the mechanics for preparing the consolidated statement of profit or loss, which we actually found that not to be too different from what we've seen in the consolidated statement of financial position. So what we are doing is that we are taking the parents' statements of profit or loss items right from revenue, as you can see from the separate financial statements here, through to the profit for the year, and if there are any other comprehensive income items, we are going to pick them. So we pick the parents' items on the financial statements, which is the consolidated statement of profit or loss, and then we are going to add those of the subsidiary or the subsidiaries. And I said that for financial reporting, the subsidiaries are up to 2. So in the examination, you might see more than one subsidiary. So, but the principle is the same. So just take note of that. So in this video, we are coming to look at a question here to set ourselves running when it comes to the consolidated statement of the consolidated statement of profit or loss and other comprehensive income. So we have a group here, and we have the financial statements relating to two entities, Paris and Sunny, and we have their revenue, cost of sales, distribution cost, administrative expenses, investment income, and then taxation. So we have additional information here. The first additional information is that Paris paid 1.5 million on 31st December 20x1 for 80% of Sunny's 800,000 ordinary shares. This information will give us what we call a group structure. So as I said, when you get a question, first skim through, and then you can draw your pro forma statement of profit or loss, or if it is the statement of financial position, you draw the pro forma consolidated statement of financial position. So first skim through the question as we are doing, and then you can pick up some key information that you will need for certain calculations or workings. Alright. So the second information is saying goodwill impairment at 1st January 20x5 amounted to $152,000. A further impairment of $40,000 was found to be necessary at the year end. Impairments are included within administrative expenses. Alright. The third one says Paris made sales to Sunny at a selling price of $600,000 during the year. Not all of the goods has been sold externally by the year end. The profit element included in Sunny's closing inventory was, so in this particular information, the third information here, we can see intra-group trading as well as provision for unrealized profits, right, on unsold inventory. So we are going to look at that and see how that plays out within the consolidated statement of profit or loss. The fourth information here is saying that additional fair value depreciation for amounted year amounted to $10,000. All depreciation should be charged to cost of sales. Alright. The fifth one is saying Sunny paid an interim dividend during the year of $200,000. Okay. Paris values the non-controlling interest using the fair value method. So prepare a consolidated statement of profit or loss for the year ended 31st December 20x5 for the Paris group. So we have the information here. We are going to draw up the pro forma consolidated statement of profit or loss as we have seen here. So first we start up with the name of the group. Here is Paris group, and then we have the name of the financial statement, consolidated statement of profit or loss for the year ended under it. And then this is Microsoft Excel. So this is going to be helpful, especially for those who will be using computerized systems for their exams, right? So this is how you present your information. For those of us who are writing manually, we can actually put brackets when you write the financial statement line item. You put a bracket, and then instead of putting it under these subheadings, you can put it inside the brackets, all right, as I explained in my previous videos. All right, so we have that. And then quickly, to draw up the pro forma financial statements, we can go to the separate financial statement here. As I said in my first video, this particular statement you are seeing here is what we call the separate financial statements, and it is prepared in accordance with IAS 27, separate financial statements. So what this means is that when a parent buys majority shares in a subsidiary, the parent is supposed to present the separate financial statements of the subsidiary in its account, and we call that statement, the two of them combined, the separate financial statements. So it is from the separate financial statement that we derived the consolidated statement of, or the consolidated financial statements. All right, so this is the separate financial statements. So it is very important for you to understand this, for you to appreciate what we are doing in consolidation. So this is the parent financial performance. When you are preparing your financial statements, because you have a majority share or you control another entity, you are supposed to present the entity's financial statements as well, together with yours, and we are calling that the separate financial statements of the two entities making up the group. Then after that, we will move from this stage onto this stage. Presentation actually starts from IAS 1, presentation of financial statements, and then where that entity that has applied IAS 1 controls another entity is going to add the financial statement of that entity which has also been prepared in accordance with IAS 1. But in this case, when you are putting them together in your financial statements, you use what we call IAS 27, separate financial statements. All right, so that's just a small tidbit to help you understand whatever we are doing here. So let's get back into what we are doing. So we are going to draw up the pro forma, and what we do is that we are going to add the various line items of the parent and then the subsidiary. All right, we are going to add them together. So we have revenue, we will have our cost of sales, we will have gross profit, we will have distribution costs, we will have administrative expenses. So we have our administrative expenses. We will also have the profits from operations. We will have investment income here. So this is the pro forma statement of profit or loss that we are trying to draw up here. So, and then we also have the profit before tax, and we will have taxation or the tax expense. So we'll have our taxation here, and then finally we'll have the profit for the year. this one, in this particular example, we don't have other comprehensive income. If we had had that, we would have brought them here, other comprehensive income, and then usually we'll have a revaluation gain or revaluation surplus there as other comprehensive income, and then we'll have our total comprehensive income. Then, in addition to this, we are going to split the profit for the year between the non-controlling interest and of the parents of the shareholders of the parents. All right, so this is how we are going to do it. All right, so this is how we are going to do it. We will have profit. We have profit attributable to so we have profit attributable to the first one, parents, owners of parents, which is the shareholders of parents, and then non-controlling interests. I explained it in my previous video, so if you haven't watched my previous video, please go back, watch it for you to understand what I'm doing here even more. All right, so this is it, and then we'll have our profit for the year. Then quickly we can, to make the presentation a lot clearer, let me highlight some of the calculations we'll be doing. So gross profits, profit from operations, profit before tax, and then profit for the year, and then profit attributable to, also highlighted for us to see clearly what we are doing here. Then for revenue, the principle is add all revenues and expenses of the parent and the subsidiary. Add all the revenue and expenses of the parent and the subsidiary. So we are going to pick each of the financial statement items line by line, and we are going to sum them together. So we have our revenue for the parents 3,200. So we have that, and for the subsidiary is 2,560. Let's leave the adjustments for the meantime. Then for my cost of sales, these are negative figures. If you like, you can put them in negative, but in this case I want to make them positive. So 2,200, 1,480. Then my gross profit will be there, but let's leave that for now. That is going to come under this particular place here. All right, so we'll leave that for now. Then we'll have our distribution costs. We have 160 for the parents, 120 for the sub. Our admin expenses, we have 400 for the parents, we have 80 for the sub. Then we have our profit from operations. Investment income, we have 160, we have 0 for the sub. Then our income tax, we have 400 for the parents, we have 480 for the sub. Alright, so then we will have our profit for the year. Now that we have this, we are now going to the additional information and then work out any adjustments that we need to do or we have to make on these figures before we will finally consolidate them. Alright, so the first information here is telling us that Paris paid $1.5 million on 31st December for 80% of Sunny's so for Sunny's 800 ordinary shares. So we can have here, and then we'll have our group structure. Okay, now the group structure is really important, and I'll tell you why in a moment. So we'll have Paris, who is the parent, and then we will have Sunny, who is the subsidiary. Then quickly let me set some symbol here to indicate that this is moving from here to here. So let me pick this and draw a line here just to show something. So I have the line there. My line is actually straight. So we have that. Then the parents acquired 80%, right? 80%. So I'll put my 80% here, and then we'll indicate the acquisition date and the reporting date. This is very important when it comes to the consolidated statement of profit or loss. It is as important as we have a statement in the statement of financial position consolidation. All right, so just take note of these things because of the issue of mid-year acquisitions. We will come to that later. So we will have our acquisition date. My acquisition date here was 31st December 20x, and then the reporting date as I said before, reporting dates can be found at two places. First, we can find them on the date of the separate financial statements. So as we can see here, given below are the statements of profit or loss for Paris and its subsidiary Sunny for the year ended 31st December 20x5. So that's the reporting date. Or you can find the date in the requirement of the question. Prepare a consolidated statement of profit or loss for the year ended 31st December 20x5. So as we can see there, so the reporting date is 31st December 20x5. So this one has no issues. So we have 31st December 20x5 right there. So our post acquisition period is equals, so we have 31st December 20x1, that is the same as 1st January 20x2. So we have 20x2, 20x3, 20x4 and 20x5. So that's 4 years. All right, so I hope I'm correct. So that's 4 years. Okay, so that is the group structure. Now the group structure, as I said, is very important. It's very important. So if the parent controls 80%, then NCI and put it here, controls 20%. All right, so NCI controls 20%. So I can just put parents there and then NCI. So it's make a lot of sense here. All right, so very important. Structure is very important, especially when it comes to the determination of the acquisition date, reporting date, and then the post-acquisition period. It's very important. It also helps you to identify quickly the percentage holding of the parent and the subsidiary. Some of the questions do not actually give you the percentage holding just like that. You have to calculate it out. So the group structure will help you to do all of that. All right, especially when it comes to the complex groups. When it comes to the complex groups, you will find that the group structure will actually help you out a lot. Then the second working we would like to do here is going to be intra-group adjustments, as we have seen in our question. All right, so we have intra-group adjustment. Now for the goodwill, we'll tackle that later, so relax, and then we'll see how the goodwill impairment is used with consolidated statements of profit or loss. So we identified intra-group transaction within note 3. Paris made So this is what I'm reading here. Paris made sales to Sunny at a selling price of 600,000. Now, from my previous video, we know that all intra-group trading, which actually means a sales in one of the group entities and a record of a purchase in the other, has to be eliminated. All right, because we are summing up the sales and the purchases, which is included in our cost of sales. Purchases is included in the cost of sales, so we are going to adjust our cost of sales. All right, so what we do is that this 600,000, which is the intra-group trading, has to be eliminated. And how are we going to do that? We are going to deduct it from our revenue and then deduct it from our cost of sales. So revenue has a credit balance. All right, so to deduct anything from the revenue, we will have to debit it so that it will have an opposite effect on the revenue figure. So what we do is that we are going to debit revenue with how much? 600,000, and then we will credit our cost of sales with how much? 600,000. So by doing this, we have eliminated our intra-group transaction. As I said, revenue has a credit balance, so debiting it means you are reducing its figure. All right, and then cost of sales, which in this case we are considering the purchases element, is also going to be credited. Purchases has a debit balance, so crediting it is going to reduce it. Right, so that's what we are doing exactly here. Then there is an element of unrealized profit. When the sales was done at a profit. In the goods in inventory has been sold, and we are seeing the consolidated financial statements. We are presenting their financial statements as a single economic entity, as those of a single economic entity, which means that everything we are doing here should be net of any profit that we might make within ourselves. Now, this profit, 30,000, the note is telling us that not all of the goods had been sold externally by the year end. The profit element included in Sunny's closing inventory was 30,000. So this one, we are even lucky that they've given us the profit element directly. Sometimes they'll give it to you as a margin or as a marker, and you have to strike that percentage on the value of the inventory that has been left in the stores at the year end. All right, so we've been given our provision for unrealized profit to be equal to 30,000. So how are we going to do this? What we are going to do is that because closing inventory reduces cost of sales, this 30,000 is an increment of the closing inventory. So what we are doing is that we are going to reduce its effect on the cost of sales by adding it back. All right, closing inventory reduces our cost of sales, which means that the more our closing inventory, the less our cost of sales. So if the closing inventory has been overstated by the provision of unrealized profits here, then we would have to add this particular value to our cost of sales so that that over deduction will be restored to its normal cost. All right, so that's what you are doing. So we are going to debit our cost of sales, 30,000, with the 30,000 here, and then we are going to, can you guess what we are going to credit? All right, so we are going to credit our closing inventory. So credit our closing inventory, or also with 30,000, so that at the end of the day, the cost of the closing inventory will be the cost to the group. The cost to the group. and then the over deduction on cost of sales due to the increment of the closing inventory by this amount will be added back to our cost of sales. All right, so that is exactly what we are doing here. And so that at the end of the day, the effect is completely eliminated. The 30,000 here reduced our cost of sales, so adding it back will bring the effect to zero. Closing inventory has been overstated by this 30,000. Adding it back or subtracting it, is going to reduce its effect to zero. That is it. All right, that is it. So this is how we are going to treat it. And then our third, let me actually bring this down. So our third working is going to be the fair value adjustment, which is note 4. Additional fair value depreciation for the current year amounted to 10,000. All right, so we are talking about additional depreciation. Now I have treated this theoretically in my previous video, so you are putting it into practice. So as I told you, if you are getting lost, go back to my previous video and read what I said when it comes to excess depreciation. All right, with regards to the consolidated statement of profit or loss, this is not different from what we've seen under the consolidated statement of financial position. So what do we have here? We've been told that there has been additional depreciation for our non-current assets. So we know that depreciation is always subtracted from our cost of sales. Nothing has been said about whether the non-current assets was transferred between the group members. All right, so we are going to treat it as a normal depreciation. So normally what we do is that we've been told that it should be charged to cost of sales. So what do? We are going to debit cost of sales. That is going to increase our cost of sales by how much? 200,000. And then we are going to credit. The credit balance is going to our non-current assets NCA, and that will be 200,000 as well. All right, so that is the third working. Then finally we'll have a fourth working here, and the fourth working, as I said in my previous video, is the determination of the share of the NCI in the subsidiary's profit. All right, so what is the share of the NCI of the subsidiary's profit for the year? So that's what we are going to calculate for in our workings 4. So we'll have NCI's, so we have the NCI's share of Sunny's profit after tax. All right, and to do that, we will have Sunny's profit for the year, or profit after tax, or profit for the year. So we'll have the subsidiary, which is Sunny. So Sunny's profit for the year, and then we are going to adjust this particular profit for any item that affects the NCI or this particular profit of the subsidiary within the post-acquisition period. So we'll have less any fair value depreciation which we have, and then we'll also less impairment. Now impairment is not always here. Impairment loss, it is not always here, and I've explained that in my previous video. And then we'll have our adjusted profit, and then we are going to strike the NCI's percentage on the adjusted profit. All right, to get our NCI's percentage share. So quickly we come here. What we are going to do is what is the subsidiary's profit for the year? Let's go to the separate financial statements and look for the subsidiary's profit for the year, and that is $400. Remember, these are in thousands of dollars, so quickly let me put my dollar sign here with my level of abbreviation. So Sunny's profit for the year is $400,000. So quickly let me change this to text. The text, so that we will have this 000. All right, so we have that. Then the fair value depreciation is how much? 10,000. And I'm going to explain why we are putting that there, and we are lessening it, so I'm going to put it as a minus 10. All right, and then we'll also have the impairment loss of 40. So let me put my negative sign there, 40. I'm going to explain this in a moment. So we're going to have the adjusted profit of how much. So I'll do my alt equals to add everything together, and that gives me $350,000. And then let me bold this, and then I'm going to strike the put something here. All right, so we are going to strike the NCI percentage, which is 20%. So I'll come here, I'll have my adjusted profit multiplied by 0.2, which is the NCI's percentage, and that will give me 70. All right, now let's go to the fair value. Additional fair value depreciation for the current year amounted to 10,000. Now the fair value, nothing has been said about the fair value, so we are assuming that it has affected both the NCI's profit as well as the group profit. All right, so we are going to treat this same fair value depreciation inside the consolidated financial statements. All right, so that's the purpose for doing this. And then for the impairment loss, we are using the impairments. We are seeing impairment loss here because we were told that the parent values the non-controlling interest using the fair value method, and from the we've learned that whenever non-controlling interest is being measured at the fair value method, we always apportion any impairment loss of the goodwill between the parents and the subsidiary. So that's exactly why we are putting impairment loss. So whenever NCI is measured at fair value, we are going to apportion any impairment losses between the NCI and the parent. But where NCI is measured at the proportionate share, then this impairment loss will not come here. Rather, all the impairment loss will be used in the consolidated statement of profit or loss. All right, so that is it. We've done almost all the work. All we have to do is just to put our figures into the consolidated statement of profit or loss, and then we are done. All right, so as we said, the intra-group trading is going to be subtracted from our revenue and then from the cost of sales. All right, that's the principle. Any sale of inventory between the parent and a subsidiary is subtracted from revenue and subtracted from cost of sales. So how much was it? It was 600,000, and then for so have 600 here, and then we also have 600 here. Now these are positive values. Make these positive values, so I'm going to make these negative values. All right, so that when I add all of them together, I know that they are going to have a negative effect on the balance. Assuming I make my cost of sales as a negative, then I can make this as a positive. If these figures are negative, as you've seen in the separate financial statements here, then I could have made this a positive figure, so that when these are negative, this will have a negative an opposite reaction or impact on the figures. All right, either ways we are going to do that. So we'll have that for now. And then from our workings, we've got to realize that the provision for unrealized profit of 30,000 should also be added, should be debited to our cost of sales, which means we are going to add it. So what we got there, so what we have here is that, let me put my minus equals figure here, and then I'm going to add 30 to this. All right, I hope you understand it. So I'm going to add 30 because you are debiting it to the cost of sales. This was credited. This is a credit, so this is a minus. This is a debit, so it's a plus. You are adding it back. All right, so you have a net effect of 570 there. When you are writing manually, you are going to put this as this. We'll have 2,200. Then we'll add that of the subsidiaries balance 1480. We'll subtract our intra-group transaction of 600, and then we'll add our provision for unrealized profit of 30. All right, then I can close my parentheses for now. Now let's go to the depreciation. What is depreciation expected to be charged to? Now depreciation is also to be charged to our cost of sales. So what we do is that we are going to add another 10 here. So I'll come here and then I'm gonna add 10. As I said, we are treating the depreciation as a normal depreciation, so we are adding it to our cost of sales. All right, if you don't understand this very well, you can watch my video on the preparation of the single entity financial statements. I have a video on that, so you can go and watch it out to understand how we prepare the financial statements. So I'll add the net effect of 560. So now that we have done all the adjustments, I think we can add them to the alt equal. I'll have my alt equals to add horizontally. So I have 5160. I can copy the formula down, let me undo that. I can copy the formula down using Control D. So we have 2 that, and then for now I can put this as a minus. All right, so that when I add it using alt equals, I'll add these two figures together. I'll have my gross profit, which I can bold in here, and then also put a border around it. All right, so that's our consolidated figure there for us. Then the distribution costs. Nothing has been said about our distribution costs, so there's no adjustment here. So what we do is that we are going to have our alt equals and add everything there, and then I'm going to make it negative. I'm making it negatives so that I can just add them together and then remove. All right, then we have our administrative expenses. Something has been said about our administrative expenses. Let's go to the workings and check that out. All right, so we don't have it in our workings. Let's go to the notes. So we've been told that the further impairments. Now the impairment information here are 2. We have goodwill impairment at 1st January 20x5 amounting to 152,000. Now assuming they have told us that we are to calculate goodwill in this particular question, that is when we are going to use this particular goodwill impairment amount, because when it comes to goodwill calculation, after getting the goodwill at acquisition, we will subtract or we will deduct the impairment of goodwill that has been accumulated since acquisition. But this is the statement of profit or loss, and we are considering only further impairment of the goodwill, and that is why we are using this 40,000 here. And so we have ignored this particular one, which would have been used in calculating the goodwill amount. But this further amount impairment is what is occurring within this particular year. Okay, so we are going to just pick the further impairment and then leave the initial goodwill impairment here. Right. So that is it. This 40,000 is to be included within our administrative expenses. So what we've got there is that we are going to add the impairment, just as we add depreciation, we are going to add the impairment to our administrative expenses. I hope you got it. I hope you get it. So we will come here and then we'll have a 40 here as our goodwill impairment. Then I'll have my alt equals, sorry, this is supposed to come here, so alt equals, and then I'm going to put my negative sign in front of the sum, and then I'll sum that together. So we have our administrative expenses, adding it from the gross profit through the administrative expenses is going to give me my profit from operations. So we'll have alt equals, I'm going to add from here up to here, and then I'll enter, and that gives me my profit from operations. I'll bolding this to differentiate it from the, and then I can insert my border there, and then we'll have our investment income. Now this investment income of 160 is deemed as an intra-group transaction. Why? Because in the notes we've been told that Sunny has paid dividend during the year of 200,000. All right, and this particular dividend is likely to be the investment income to the parents. That is why we have just 160,000 under the parents and 0 for the subsidiary, which means the subsidiary doesn't have any investment outside of the group. All right, so this deemed as an intra-group transaction, and hence is going to be eliminated. So what we've got there is that we are going to have negative 160 here, and that is going to bring the effect, sorry, this is 160, and that's going to bring the effect to 0. So I'll have my alt equals, and that's going to be 0 there. So my profit after tax, or profit before tax, sorry, becomes this particular amount here. So I can just bold in that, and then my taxation has remained the same. Nothing affects our taxation. So I'll come here, and then the adjustment is 0. So I can quickly come here and then sum all of that together. So I have my alt equals and sum everything here together. So that gives me 880. Let me put that as a negative figure. And then I'm going to sum these together. So I'll have my alt equals here, and then I'm going to sum that together. And so our profit for the year becomes 360,000. Let me put that nicely. Then let me bold in it as well. All right, so that is our profit for the year. Then what we are going to do is that we are going to split the parents, this particular profit, between the owners of the parents, which is Paris, and the non-controlling interest. All right, so what do we have here? We have our profit for the year 360 here, or if I like, I can refer to this particular profit here as the total right there, and then I can still put my borders there. Then how much is the non-controlling? Let's get that. This is 70,000. So I'll have my 70,000 there, and then the difference. So let me put here the balancing figure. So that is balancing figure. So I've got there my balancing figure. Sorry. Alright, so that's a balancing figure. And how do we get that? We are going to pick the total profit for the year, and then we'll subtract the non-controlling interest element, and that gives us the owner's profit for the period. Alright, so this is how we calculate, or this is how we prepare the consolidated statement of profit or loss. It's so simple. It's so simple. You just have to make sure that you are treating the items in the right way. You are treating the items in the right way. So just like that, we have our consolidated statement of profit or loss for the period. Before I end this particular video, I want to talk a little about some other adjustments that we might have within the consolidation. Okay, so we have here some other adjustments that we need to do. One of them is acquisition related costs. Now, whenever a parent acquires a subsidiary, there may be acquisition costs that are related to the acquisition of the subsidiary, and such costs may include legal fees, advisory fees, valuation or other professional or consulting fees. Now, these are not included in the costs of investment as with the consolidated statement of financial position, but rather they are expensed to profit or loss in the period in which they are incurred. So whenever there are acquisition costs other than the purchase consideration, what we do is that those costs are going to be expensed in the consolidated statement of profit or loss, but not included in our cost of investment. Alright, so that is it. Then the second thing I want you to take note of is the deferred consideration. Now, as we've learned previously, we know that the deferred consideration is actually discounted into its present value. And what we do is that we debit the goodwill, that is the cost of investment, and then the present value also becomes a liability. Whether it is non-current liability or current liability depends on the time frame of this particular deferred consideration. If it is more than 1 year, it becomes a non-current liability. If it is less than one accounting period, it becomes a current liability. Now, the liability, as I said, represents the present value of the consideration. And so, what we do is that we unwind the discount. Unwinding the discount here means that we are going to strike the percentage, the cost of capital of the company or of the firm by the present value of the consideration, taking into account the period between the time the deferred consideration will be paid and the financial reporting date. Alright, and then this particular unwinding of the discount becomes a finance cost. So this finance cost is going to be debited in the consolidated statement of profit or loss. In the consolidated statement of financial position, we treated this under the retained earnings, because included in retained earnings is actually the profit for the year. But in this case, the profit for the year is what we are calculating in the consolidated statement of profit or loss. And so we are going to deal with the unwinding of the discount, which is a finance cost, within the consolidated statement of profit or loss as a finance cost. Alright, so we will debit the finance cost, and then it is going to increase our liability. In this case, it's going to be a current liability. So I want you to get the deferred consideration as well. We are going to solve many other questions, so you will get to understand all of these intricacies within the consolidated statement of profit or loss. And then finally, I want you to take note of the contingent consideration. When it comes to contingent consideration, if the contingent consideration will be settled in cash, what we are saying is that the amount involved is going to be remeasured at the reporting date. Now, this came in the ICAG financial reporting exam last November, so take note of it. If the amount will be settled in cash, what we do is that we will remeasure this particular amount, which is actually a liability, at each reporting date, and then any changes. So usually it says that the contingent consideration, let's say there is going to be a cash amount of, for example, let's say it is a cash amount of $200,000, all right, at the acquisition date, so AD there. Then at the reporting date, they might assess conditions and then tell you that this 2,000 is no longer possible, rather it's going to be what, 1,150,000. So that's what they will tell you. Now what you are saying is that the difference between these two figures at the reporting date is going to be recognized in profit or loss, but rather it is not going to be included in calculating our purchase consideration in goodwill calculation. All right. And then we also have another one here that if the settlement is in shares, contingent consideration can be settled in shares. When it is settled in shares, it is not remeasured, but it can change. The number of the shares can change. The number and hence the value of the shares can change. And this change is recorded in OCI or equity when the shares are fully issued. They are recognized in equity or OCI when the shares are finally issued. So I want you to understand these particular things before we get to another question. All right, so that is it for this particular video. I hope you've learned a lot in this particular video. If you have done so, please subscribe to the channel, and I will see you again in the next video. Until then, it's a bye for now.